So, hi, good morning, everyone. Thank you so much for taking out time on a Saturday morning to join this webinar. I would like to welcome all on behalf of ORIM advisors for joining the webinar with the topic where we would discuss how one should select their stocks when investing for the long term. So, to begin with, I'll just take a heads up if my voice is clearly audible. So, if anyone can just type in a yes in the text box if I'm clearly audible to everyone. Okay, great, great. So, we've got the responses. So I'll just share my screen and we would have the agenda of the webinar in such a way that we've got a short presentation in place. So we'll discuss the same for, let's say, about 25-30 minutes. And then I would be more than happy to take up your questions and solve all your queries with respect to investing. So I'll just share my screen. Please let me know once my screen is visible. Okay, great. So I've got a confirmation as well that my screen is visible. So as I rightly said, I'll just repeat the topic, that the topic is that we would learn how to choose the right stock, which is the right investment strategy for the long-term horizon. To start with, I'll discuss how the agenda for our current today's webinar. So today's webinar definitely would involve these topics, but I've involved 2-3 polls as well to have more interaction with you guys. And I would also like to provide you a free advisory product at the end of the webinar. So stay tuned till the end to get the free advisory product for your portfolio. So the agenda for today's webinar is basically we would be discussing majorly 4 aspects. One being that I would be discussing in depth about the principles of Warren Buffett, one of the veteran investors in the stock market, who's currently in his 90s and is obviously been one of the best value investors from the beginning. Next, we would be studying in terms of how one should find undervalued stocks and how actual wealth is created in undervalued stocks in the long term. Third point being that we discuss today is how this fundamental research process should actually work. So everything should be research oriented whenever selecting a stock. Hence, we should understand in detail how this process should be followed, what are the resources or data information that is available online which we should use for conducting this research. Once you've done a research, everybody knows, okay, they've bought a stock. But what is more important also to understand is that what is the right time to sell a stock. So we'll also throw light on these aspects in terms of what is the right time one should sell and how one should take a selling decision. Because this is where many people falter, wherein they've got good numbers in terms of returns in their portfolio, but they are not able to realize the profits. So I would tell you exactly how that should be done. And post that, definitely, I would like to speak a bit about ORIM advisors and how we advise clients for investments in the Indian equity markets. And I would like to give you guys a brief about us as well, so that we can stay connected, stay in the environment of investing, and always keep learning. So to start with, as I said, we would understand the principles of Mr. Warren Buffett. So Warren Buffett has been one of the most long-term value investors that I've ever seen. And the most important thing that he does in his investing is that he's got patience. He invests in a company with a lot of patience and for the long term. Now, before I hop on to these points in terms of what Warren Buffett basically does, let's have a small poll. If you guys can just vote in and tell me that how many of you have actually done fundamental analysis in the past. So that would help me understand in terms of how I can take this up ahead in terms of explaining these points. Can we get the poll, guys? So we got the poll, we're getting results. Okay, we'll just wait for around 15-20 seconds, and then with the results, we'll proceed ahead. Okay, so I've got around 10 responses now. Let's wait for 5 more seconds, and probably post that we can proceed with our discussions. Great, superb. So it's almost a tie wherein 50% people have done fundamental, approximately 50%. So 58% have not done fundamental analysis and 42% have done it. All right, that's a decent base. So don't worry, guys. I've got answers to all, and I would discuss every aspect in detail so that the ones who have done it earlier, they get a better understanding, and the ones who are beginning from the start, they would understand things from the base. Thank you guys for sharing your responses for the polls. So as I begin with the principles of Warren Buffett, the first principle that he suggests is one should focus on the intrinsic value. So when I say the intrinsic value, it basically means that we should focus on the value that we are paying for any stock and what is the underlying value of that business. We should never look at a stock by its actual stock price. What one should actually understand is what is the book value or what is the actual value of the business and of the balance sheet. So once you understand the value of computing intrinsic value, that is when you would understand that how actually you should select a stock and understand how, if a stock is expensive or it's cheap. Market cap is just a number which has been derived through demand and supply, but the actual intrinsic value is something which you need to judge for any investment that you make. Second most important point being that whenever you are doing fundamental analysis, one should have a long-term perspective towards investing. This means that why long-term? The reason being that if you do a business, you're putting in money in a business, you're trusting a businessman that the money that you've given, he would make use of it and grow it with a good performance in the company. Now, growth in any business is always not linear in a straight line. Growth happens in a phased manner, and it is not that one would outperform every time. So one should have the patience once they've invested. But how one should have that patience? One would have that patience only when they have proper trust in the business, they trust the management, and they are comfortable with the valuations. Hence, whenever we analyze a company, we should have the long-term perspective in mind before taking any investment decision. And I personally believe that for any long-term investment using fundamental analysis, minimum investment horizon should be 3 years, nothing less than that. Third most important thing, which is very simple to understand, but we majority of the times don't rely to it, wherein one should invest in what you understand. So you should invest in only those companies wherein you understand the businesses, you understand what's basically happening, what are the limitations in the business, what are the advantages in the business. And once you have that comfort, only then you invest in the business. Because when times would be good, everyone would have a gala time. But when times would be bad, it would be difficult for you to understand that why times are bad, and you won't be able to keep that long-term perspective. So you should invest in only those businesses which you understand, and one shouldn't have that FOMO factor that you need to participate in every stock rally or you should have every stock that doubles up in a year. No, you should be satisfied in terms of the right stock that you understand and you are invested in. Next, in terms of how, once you understand the business, it is very important that you understand how strong the management is, how strong their objectives and the vision is with respect to the company, and what are the moats. So in terms of how strong the management is, this is something which you would understand when you probably read the annual report. You go through the chairman's report in the annual report. You look at what the management commentary is in different con calls or different interviews. So currently, readily data is available everywhere. So there are videos available on YouTube. There are other information sources which I'll be sharing ahead in this presentation. So you can use those resources, get maximum data, because data availability is not a problem in these days. You should understand those data points and then accordingly take an investment decision in terms of the strong management. Is it a strong management or no? Next point comes in terms of what moat does the business have. When I say moat, it basically means that it should have a differentiated business which has strong entry barriers. Because if it is not a differentiated business, it does not have strong entry barriers. Anyone and everyone would like to get into that business if it's a good business, and then the increasing competition would reduce the profits and you won't be able to earn much on your investments. Hence, even after understanding the business, you should understand if it's a differentiated business or no. This is of utmost importance. And last point being that never speculate. Don't buy a stock with a 2-day time horizon or a 2-month time horizon. Nobody in this world knows that if you would be earning well in a 2-day or a 2-month time horizon. One shouldn't bet or gamble over stocks. It should always be with a long-term investment perspective with no speculation. You should go for any investment that we do only once you understand what exactly the investment is all about, and then take a decision for the same. So with this, I'll just shift to the next slide. So we've completed basic few principles of Warren Buffett in terms of how investing should be done and what are the basic aspects one should keep in mind before proceeding ahead. Next is, obviously I've told you that you should find the undervalued stock, but it is very important to understand in terms of how one should find it. What is the process one should follow while finding an undervalued stock? So what defines the undervalued stock? Undervalued stock basically means a stock which is available at a reasonable price, as compared to other peers. And reasonable price doesn't mean only as of today. Reasonable price also means that it is at a reasonable price considering the future earnings perspective for the company. So it is very important that you understand the future as well in terms of how the future would work, how the profitability would come in the future, and accordingly decide if the stock is undervalued or no. And one should never compare companies of different sectors in terms of valuation, because a company in the IT sector would have a completely different valuation metric, or the peers would have a completely different valuation metric as compared to a company in the automobile sector or any manufacturing company. So undervalued stock is always comparable and it is relative to a sector, and one should concentrate on that. So I mentioned 4 bullet points here to basically signify what defines an undervalued stock. The first one is about intrinsic value assessment. So as I told you, a stock which is priced below its intrinsic value indicates that there is a potential of undervaluation. Intrinsic value is basically the book value, the actual value of the business, not the market cap. Book value basically is computed by taking the assets and subtracting the liabilities for a particular business. Next point says about reasonable forward PE. So this is what I exactly told now, that the forward PE basically means that whenever we are judging a stock, the first valuation metric that comes into our mind is PE, which is price to earnings, which basically means that market price per share divided by the earnings per share. But always we should see that we should also look at the forward PE. I'll tell you how the forward PE is computed. Forward PE basically means that you consider the price of today, but the earnings of the future in terms of what growth rates has been guided by the management. And accordingly, you should be knowing in terms of what your company is earning in the future, and accordingly the price is discounted, because markets are very swift, markets react very fast. So markets always value a company as per its future performance and not as per current performance. Hence, we should value it as per the forward PE. There would be certain companies which you would think that are very costly at the current PE, but they are costly today because everybody has valued them according to their future. So you should understand that what is the scale of the business can achieve for a particular investment, and then accordingly allocate the forward PE. Key valuation indicators on a broad perspective which are included there are major 3 aspects, which are price to earnings, price to book, EV by EBITDA. So price to earnings is something which I've already discussed. Price to book basically means price divided by the book value, which is the intrinsic value. And EV by EBITDA is intrinsic value to enterprise value to EBITDA. This is also a very good multiple which helps you understand what range the company is currently in the market as compared to EV by EBITDA multiples. And don't worry, where the question would be that where would you find these details? You would be going ahead in slides. I would exactly explain where all these resources are easily available to you with just one simple click. And the most important thing, that is, apart from the company, one should have the market comfort and should be comfortable with the volatility. Nobody can predict when the markets would fall or the markets would rise. There will always be volatility in the markets. But what one should keep in mind, that the business that they've bought, they should have comfort in that business and should have the comfort that they are buying it as a reasonable valuation, which would create the patience and confidence for them to hold it for the long term. So that market comfort and volatility should always be there whenever you're finding or investing in a business. Now, finding undervalued stocks has various key techniques. I've broadly mentioned these techniques, but obviously due to shortage of time, I cannot concentrate on each technique. I would keep a separate webinar for this, wherein I would concentrate more on these techniques. But I'll definitely talk to you in brief about this in terms of what are the techniques. One is obviously a value investing technique, wherein you look at stocks which are available at a undervalued price. Then second is comparative analysis. You have conviction in a business, you wish to stay invested in a business, but all the companies are expensive in that particular sector. So now what do? The best approach there is that you see that relatively compared to the peers, which is the cheapest company that is available with the maximum growth potential in future. So when you measure these 2 metrics together in terms of growth potential and the comparative analysis of the valuation, that would give you the right stock which would have minimal downside. Next is definitely a common valuation metric which would have been used by major of you, which is basically the discounted cash flow method. The discounted cash flow method basically discounts the future cash flows of the company and you give a multiple to it to basically interpret in terms of how the company should be valued considering its future cash flows. And the last point is market sentiment. You should understand what is the right regime. Markets have been favorable in the last 2-3 years, except if I would remove the period of last 3-4 months, markets have been very favorable and people have generated very good returns. But one shouldn't consider that stock markets always would be the same. In the long term, there are different market regimes, different sector regimes, and markets behave differently. Previous 2-3 years won't be exactly the same as the 2-3 years coming ahead. It would be very different from what it was in the past. And it is not just about the markets. It depends on how the corporate earnings are going up, what are the guidances, how are the government spends planning out, how are the foreign investors participating in the market. So all of these things have to be understood in detail before investing into a stock or defining your profit margins or your exit targets. So this was basically about basic principles that we discussed about investing. Now next what we have is a fundamental research process in terms of how institutions or boutique houses like us, what is the kind of process that we follow when investing any stock? What are the things one should look at? And things, be it investing or any business or any job or whatever work you do, whenever you do anything in a proper processed manner, results have to be good. But the objective should be that we follow that process in a consistent manner every time. Just a second. So when we are basically following about an investment process, the fundamental investment process, it is very much important that you define your investment scope. Investment scope is decided not exactly by the market cap you want to invest in, but basically the type of businesses you want to be a part of or you are comfortable buying. So there are businesses who are in the budding stage, which I would say are in their initial stages, and there's a long growth trajectory ahead. Now, these kind of companies definitely have a higher potential of growth, but on the same time, there's also a downside for the same. That the risk of failure is high because what they are doing or what they are building is now starting from a small stage, and when their size increases, obviously there would be higher risk and higher problems, limitations that would come up in a business. So it is very important to understand that. Second aspect is probably companies which are in the growth stage, wherein they have come upwards from the budding stage. They have started to grow slowly, and going ahead, obviously they would continue this growth rate. So this is a very sweet spot between a mature stage and a budding stage, wherein companies have partially proved themselves and there is a long runway ahead. So this is a very good spot wherever one wishes to find good opportunities and also can take a little bit of risk. And the last stage is a maturity stage, wherein these are companies which have established their businesses. They're there in businesses over a long period of time and wish to grow ahead, but definitely because of their size, growth won't be exponential. It would be in a slow and staggered manner. But the advantage here is that your risk is minimized, your downside is minimized. Because such companies already have their business established, so they most of the times won't run out of businesses. They would grow slow, but they would definitely grow. And the same is also reflected in the market caps of the companies, namely small caps, mid caps, or large caps, wherever you invest in. Small caps definitely have higher risk because of their size and volatility in the stock price. So one should understand the volatility and the risk before taking any investment decision. So these are few primary filters. So I would suggest you guys can also take a screenshot of this because these are very essential filters which I also personally use when selecting a stock. My favorite sweet spot is basically the growth stage of a company, wherein they proved themselves in the past and they have a long runway ahead. So these are basically companies which have a good ROC. ROC basically means return on capital employed, which means that the money that they're earning on the money that they've invested in the company, that should be higher than 15%. ROE basically means return on the actual equity value of the company. So I think that it should be anywhere more than 10% at least. The company should have grown in the past and should have a growth expectation of minimum 10% on the revenue side going ahead, because this, I think, is the minimal growth rate one should expect when investing in a company. Then we have EBITDA margins. EBITDA margins are basically the operating profit margins. So a 15% operating margin is something which I think is the bare minimum and one should have as a primary filter if you want a good quality business, a good quality stock with good growth potentials. So these are basically four major parameters which I think should be your first set of filters. And once you set up these filters, then you go ahead and understand the nitty-gritties of any business and also the limitations. In the markets, there are different kinds of opportunities available, and it is not that one rule would work everywhere. There is a different rules for every investment that you do, and there are different themes. So there are structural growth themes, there are market leadership themes, there are themes wherein there are special situations which come up, which are basically reverse merger opportunities. And definitely there are themes where you see that the company is doing well as compared to the industry and it is beating all the efficiency ratios. So when all of this is taking place or any one of these is taking place with other comforts of valuation and quality of businesses, so yes, that is the right stock and you should go ahead with investing in that stock. Next, when selecting a business, how do you understand that this is a robust business or this business would have a long-term growth perspective? So these are very qualitative factors and this cannot be numerically identified, but what one should, all cannot be numerically identified, I would say, but one should look for these when selecting a company. There should be innovation or plans for innovation in the company. If there is no innovation, there is no future. One should have that straight in their mind that without innovation, no company can grow in the future. Capacity utilization is a very good metric when you study probably manufacturing companies. You should see that how much capacity are they utilized at the moment, and with their current investment, how much more capacity then can they increase over time. So understanding the capacity utilized is very important whenever selecting a business. And a company which has good growth prospects and currently has a very underutilized capacity can definitely be a good bet. Market share gain. So this is a very good metric which helps you understand that the company is growing. So is it that the complete industry is growing or if the company is growing at a faster pace? So if the complete industry is growing, the market share would remain the same for a particular company. But if the company is growing at a higher pace as compared to the market growth rates, then yes, it is gaining market share and that's a very positive sign and that's a sign of a very good, robust business. Next is product change leading to margin expansions. Obviously, every business has its own limitations, own problems. With innovation, there are a lot of changes that needs to be done. So if you think that new products are coming in a business and that change would lead to margin expansions or profitability expansions in the business, then yes, that's a very good advantage and a positive point. That's a green flag for the business. Next is basically business turnaround. So these are situations wherein business are in times of distress and or there is a major corporate action that is going on in the company wherein there are new promoters coming in, or there is a new business idea that is coming in, or now the company has changed their ideology in such a way that they are coming out of bad times. So these are times wherein companies or businesses are available at a very good valuation, but it also comes with its level of risk, which is the risk of the turnaround not happening. So one should be aware of those points. And I think these are basically 5 major points one should look at when investing or selecting a good, strong business. Now, this is the research process which I personally follow. Once again, sorry. Yeah. This is the research process which I personally follow. It starts with basically idea generation, which is then followed by data collection. Data collection will always be structured and unstructured. It will not always be available in a number format for you. So data is something which is readily available these days. You should make use of it through the utmost extent possible. Next, we have sector-wise segregations that you should do because every sector is to be analyzed in a different manner, and one should have sectors for every KPI set for every sector. KPIs basically are key performance indicators. So the way you would measure a IT sector is not how you would measure a banking industry company. So every sector has its own limitations, own aspects that one should look at before taking any investment decision or even looking at those. So application of proprietary financial parameters are very much essential. Going forward with time, I also have plans that I would have sector specific webinars for you guys so that you would understand more in detail in terms of how one should look at when they are looking at a particular sector, and basically a webinar specifically for the banking industry or for the manufacturing industry, which would help you understand more in detail how a particular sector should be analyzed. Once these filters are applied, you should get to a watch list, and then once you get to the watch list, you should closely monitor that, and then go ahead, read the annual reports of the companies, look at the last track record for the last 10 years, listen to conference calls, and then understand what exactly does the business fit into your investments or no. Next being regarding risk analytics. In terms of, you should understand what is the risk that you have in this investment. Risks can be quantitative and qualitative. For you, the quantitative risk would be the loss of your capital when you're investing in the business. And qualitative risk is in terms of the business not growing, or you've taken a wrong call on the management, the management's not honest or doesn't have the motivation to grow the business well. So that's the risk that's there. So before taking any investment decision, you should make it a point that you write down the points in terms of what are the major aspects for risk in your investment. And then you go ahead with your portfolio construction. Now, a portfolio can always be of 20 stocks, 25 stocks. So we would also have a poll to discuss in terms of what generally is the portfolio size of investors and what I think should be the ideal size. Yeah. So before we get to the poll in defining the ideal size of a portfolio, these are few helpful sources of information which I think everybody should use when they are doing their investments. So this would include screener.in. So screener.in is a very easy website wherein you can just log into it and get access to loads of information for a company. So all the aspects or all the information, all the rules that I've explained for investing, data for all of it is available on Screener. So you don't need to go anywhere. Screener is the place for you. Next thing, there's a very good website wherein you can find good industry trends and industry growth rates which are available at tijori.in. So one should make a note of these aspects. Other than that, if one needs to excel in investing, they should make it a point, make it a habit that they have a good newspaper read every day in the morning, which gives them a good perspective in terms of the macroeconomic scenarios, the growth rates in various industries, how companies are performing. There are specific Twitter handles, so you guys can just follow me on Twitter, and then I have got a great list of followers whom I follow, which help me in my research processes. So you guys can also follow those people on Twitter to get a better understanding in terms of companies and get latest company updates as well. And last being annual reports, PPTs, and con call transcripts. So yes, ORIM also has their Twitter handle, so you can follow us as well for a more detailed insights on investing. And when I talk about annual reports, PPTs, and con call transcripts, these are the best sources to understand a company. Once you've understood in brief by looking at the website of the company, when you need to go to the integrities, these are the things which you need to read on a day, before you invest in any company. You should be well versed with all of these aspects. I started with the presentation with Mr. Warren Buffett's principles. So he is an avid reader, and now at the age of 90 plus as well, he reads 500 pages a day. So reading is something which has given him utmost knowledge, and that is how he's been able to be a great investor and a great stock selector in the past. So before I go and explain to you in terms of why selling is important, let's have a small poll wherein I would like to understand in terms of people who have done investing or who have done fundamental research, have they actually used screener.in in the past or no? So we'll wait for 15-20 seconds to get all the responses, and then probably I shall move ahead with the aspect of explaining selling when required. Okay, guys, hurry up. I think we've got quite a lot of responses after 5 seconds, and probably post that I also need to answer your questions. Okay, so we stopped the poll here, and as per the poll, we see that, okay, again, it's a tie. So 53% people have not used Keener.in. Guys, I would suggest that after the webinar, you should go look at Keener.in, look at the features, understand those aspects, and any terminology that you don't understand, feel free to Google it. Everything is available on Google for it. And the people who have been using it, you guys are doing a great job, and I think you should continue doing the same in future as well. Now, when I talk about portfolio sizing is something which one should understand, that one should not have portfolios of 50 stocks, 70 stocks, 100 stocks, because that is a portfolio that is very difficult to manage, and it becomes very difficult in also understanding the businesses or monitoring them closely. So I believe that sweet spot for portfolio, whenever you are having a portfolio, should be anywhere between 25 to 30 stocks, because that is something which keeps your risk lower as compared to a very small portfolio of, let's say, 5 to 10 stocks. Plus, you are well diversified across sectors and across market cap. So that is a good sweet spot in terms of portfolio sizing. But buying the right stock, choosing the right business, portfolio sizing, all of this only becomes true when you know what is the right time to sell, or when you sell at the right time. So I've always told that, okay, you should have a long-term perspective and invest for a 3-year horizon, but it does not mean that you buy and forget. That should never happen. Long-term view is a view of 3 years, but it is a series of short-term evaluations. You always have to be on your toes whenever you're evaluating a stock. You always need to see what's happening in the company, what are the updates, and you should understand all the aspects, and it should be as you want it to happen in terms of expectations of growth rates. There would be few hiccups in between, let's say for 1 to 2 quarters, but in the long term, the business should happen as you want it. If it's not happening as per your expectations, you would never be comfortable investing in those businesses, and that is the time you should exit. So that is the time when you should fully exit, rather, which means that there is deterioration in fundamentals or unexpected negative developments in the business. Negative developments basically means developments which don't suit you or you think won't be favorable for the business. So this call you would be able to take once you understand the business well. Or there should also be partial selling that you should do in your portfolio when the returns are significantly outpacing the underlying growth. So let's say stocks have grown, the prices have grown multifold over a period of time, but the earnings have not grown. So here the price is leading the growth rates in the company, which probably is not a good sign. Hence, a partial profit booking is essential. What probably is a good sign that the prices and the earnings go in tandem, go together, but that practically is never possible in investing. Hence, this managing your portfolio sizing, managing the weightage in your portfolio according to the earnings growth rate and the stock growth rate is very important. Portfolio optimization is very important whenever investing, which basically means that you should prioritize better ideas over the old ones. So you should always keep on going better in terms of investments, and one should never be scared of selling. And if you have a very big portfolio, I would suggest that you should sell the insignificant holdings, let's say, which are less than 1% in your portfolio, because I feel that these investments won't generate much returns, whereas these would also lead to just lagging stocks in your portfolio, which would hurt your portfolio more than the rise. Or the businesses that you are very much confident on, I would suggest that you increase your percentage holdings in those particular portfolios. So considering these aspects of fundamental investing and your portfolio allocation would help you create a better portfolio. Next, obviously, everyone has this question in terms of which sectors to look at, how one should look at investing in the future. So this is just a slide which explains that visualizing the future in terms of how one should look at the future. So we feel that secular businesses or saturated businesses won't have great growth rates in future. So businesses which have innovation, which are developing new things with the help of AI or data centers, or such businesses would do well. A huge stagnation is taking place, which means that the old saturated businesses which was labor intensive won't do that well. One should keep that in mind. Everybody says that India is growing with a China plus one strategy, but one should also understand that as India is growing, the global economies are also growing, and China is also growing. It is not that China is not growing. And in the next 20 years, India would have a significant growth rate, but at the same time, China would also grow at a very high growth rate. Next is the upgrade cycle and the luxury cycle. I believe that as the dispensable income in Indians is increasing, these themes are the themes which would do well in the next 10 years, and the next multi-bagger would probably come from these themes. So one should watch these themes closely and look for stocks or sectors which are based on these particular themes. Now, this talks about portfolio behavior. So this is probably the last slide for the day, post which we would move ahead for Q&A. So, but before we get that, can we have the third poll, wherein I want everyone to put in their inputs in terms of what is the size or number of stocks that they have in their portfolio. So we've got the third poll on. Can we get your responses, please? Okay, so most of the investors have their portfolio with less than 10 stocks. So guys, it's not bad to have that, but you should understand that what is basically the risk lying in those underlying stocks. If it's a very concentrated portfolio, you should always be ready for a higher downside in the portfolio. So understanding those aspects is important. You should understand the risk. And the ones who are having, let's say, a portfolio with 10 to 25 stocks, those are, I think, perfectly placed in terms of number of stocks. And the ones who have greater than 25 stocks, I think, guys, you should reduce it a bit, because over diversification won't lead you to generate good returns in direct equity. Your returns would replicate majorly returns of a mutual fund. But keeping all of that also aside, a portfolio never performs. All stocks do not perform in a portfolio. A portfolio, on an average, if you're investing with the right process, with the right understanding, 80% of your stocks would be winners, but there would be 20% laggards. So one should always be prepared for that when investing. And when you look at portfolio market cap breakup, I think this is the ideal breakup for anyone who's aiming to generate alpha over and above, let's say, the BSE 500 index. So one can keep this in mind and accordingly manage their portfolios. Before we proceed ahead to the Q&A session, there are two things that I would like to just share my ideology in terms of about ORIM, in terms of what basically we do, and if at any time in future you guys would want any guidance with respect to your portfolios, me and my team would be more than happy to guide you. So we are SEBI registered India-based investment advisory company. We use a lot of cutting-edge research processes. I've already told you a few of them. In terms of research experience, we've got 100 plus years of research experience, and in the past, the complete research team has got the experience of managing an AUM of more than 1,000 crores. We've got comprehensive understanding of the financial landscape with our structured multi-factor approach, basically the KPIs that I've told you for every sector. Our focus in investing is basically to build a robust portfolio with proper risk management to ensure stability of returns over the long term, and we should have minimum downside. And our fee structures are also a win-win for the client and for us, and all the clients are more than happy getting associated with us. So this is just about ORIM. I would share my email ID and my company's email ID ahead in this slide. So you can make a record of that also, and anytime if you think you require any assistance with respect to investing, we would be more than happy to guide you as well. Now, as I promised at the start of the webinar that yes, there would be a free gift, advisory gift for everyone. So ORIM would provide free portfolio analysis for your existing portfolio just for free for all the participants in the portfolio. So you may note down this email ID, and you can just drop in a mail to us, and my team shall get back to you in terms of a free portfolio analysis for your existing portfolio. So this is something which I would like to give as a gesture of thankness for everyone who's given time to attend the webinar. So guys, you can just take a snapshot of this or note down this email ID. Going ahead, I would like to open the floor for Q&A, and I would request anyone who has questions, feel free to put up questions in the chat box, and I would be more than happy to answer them. It could be anything related to investing, not pertaining to only the points that I discussed today, but anything related to investing, I would be more than happy to answer them. Please put in your questions in the chat box. Okay, great. So we've got the first question from Desha, which is that how do you assess a company's competitive moat, and what industries do you think currently have the strongest moats? So basically, a competitive moat is studied in terms of there should be good and strong entry barriers. So anybody who wants to do the same business, they shouldn't be able to easily replicate it, because if a business model is proved, and many people would easily get in there and replicate the business and have a lot of competition. So companies which have a differentiated business model wherein they've brought in a product which is difficult to develop, that is basically a mode business. And in industries, basically the high, I would say the high demand and the high level of expertise that is required in the current state is majorly, I would say, two industries. Let's say the data center industry. Creating the infra for data center is easier, but companies who are working towards having a proper software approach for having a proper software in place for running the data centers. So these companies are have a moat because there's something new and something big that is happening currently in India. Next question is from Sneha, which says that is it better to wait for market corrections to buy quality stocks or to have a systematic investment approach? So I feel that nobody can time the market. The markets definitely have fallen now, so this is a good time to start to investing. If anybody of you has not started or wish to put in some more money, so this is a good time one should do in terms of its stock allocation. And the best objective is that you start partially with a lump sum amount now, and then you build your portfolio in a slow and staggered manner so that you get the advantage of cost averaging. And one should never look with a target to time the markets. Next is how much allocation one should have to a particular stock. So it completely depends in terms of your investment approach, how much risk you wish to take. But I personally feel that one should not have more than 10% of their allocation on the higher side in a particular stock. You can start with a 2% allocation as well, and as and when you get more conviction on a particular stock, you can increase your allocations. Next question is from Shruti, which says that how much more do you think the market will fall? So this is a very simple question, but the most difficult to answer because nobody knows the bottom of the market and nobody should go there catching the bottom as well. What one should completely concentrate always on is basically that if the markets fall, you should look if your preferred stocks are in the comfortable valuation range, and if they are, you simply buy the stocks in your comfortable valuation range. The markets could fall more probably up till the budget or probably 1 to more months. But the markets would start rising whenever markets would see that there is a scope of more improvement in terms of the markets and their corporate earnings of the underlying companies. Next question is by Misbah, which says that how do you approach portfolio diversification while investing for the long term, and how do you weigh sector allocation? So sector allocation basically depends on how much conviction you have on a particular sector and what are the growth rates expected. Sector allocation can range anywhere from 8 to 10%, and I think can go maximum up to 25 to 30% as well. So that is a comfort zone that I personally prefer when allocating stocks in a particular sector. And in terms of portfolio diversification, as I said that a portfolio of around 25 stocks is something which creates the right set of diversification in the portfolio across 8 to 10 sectors. How has AI/ML changed the way analytics evaluate? So this is a very good question by Prantik, which basically I would say that it has changed the research process completely. So the analysis is something obviously that goes the same wherein we need to read, we need to understand. But the way we analyze or AI or majorly ChatGPT has changed or basically increased our speed of analysis because all the data, the summaries and all are available at a very readily available option for us. So we upload any PDFs or any con calls just to get a summary of them is very easy. So using AI/ML doing research has been very much easier than how it was earlier. Next question is how much allocation should a person have to a particular stock? So as I discussed earlier also, as somebody had asked a similar question, in a particular stock allocation can be up to 10%, but 10% also shouldn't be on day one. One should start with 2 to 3% probably, and as and when they gain more conviction or the price rises, it could go higher. But above 10%, I think would create a lot of risk in the portfolio, and one shouldn't have more than 10% allocation in a stock. So I think that helps Shruti with her answers with respect to the stock allocation. So guys, any more questions? I would probably be there for a minute or so that I can answer more questions before we wrap up this session. And also, I'll also punch in my email IDs wherein you can feel free to connect with me anytime for any queries or any kind of discussion. Would be more than happy. I have put in both the email IDs on chat, so you guys can make a note of it and feel free to reach out to me anytime for any queries with respect to investing. I believe we don't have any further questions, and great that we've ended well in time. So with that, I would like to thank everyone for their participation, for taking out time to attend the webinar, and would be more than happy to seeing you forward and staying connected with you guys. Thanks a lot, everyone. Thank you.